All right, guys, let's quickly take a look at the other event for today, released at the same time as US NFP, and that is, of course, the Canadian jobs data. Now, just like NFP, I'm not going to be trading this apart from a potential risk event scalp. I just don't see any longer term or more sustainable trades coming out of this, and I'll explain why in a second. For me, it's only going to be a potential risk event scalp and really nothing more that I'll be looking for. The reason for that is we obviously had the BOC a little bit earlier in the week. And if you take a look at what happened to rates markets, right now the markets are about 50-50 on whether we get a July cut for the BOC or not. Now, what we got from them this week is it was pretty much in line with market expectations. You know, we had them obviously cutting rates by 25 basis points as markets was largely expecting them to. They did say that they have more confidence that inflation will, move down to target. That was more dovish. But they did say that just like the ECB did, they will take each decision one meeting at a time, which was slightly more hawkish. And then obviously just confirming to the markets that should they see inflation continue to ease, then obviously more cuts could be on the cards, and that was slightly more dovish. On balance, that meeting was pretty much in line with market expectations, and it didn't really provide us with much of an edge to trade. Now, I don't see one jobs print changing any of that right now. Could a very bad print today see the markets pricing in a higher probability of a July cut? Yes. Could a massive beat see the markets pricing in a higher probability of a hold? Yes. Do I think that provides us with anything more than a risk event scalp? Probably not, right? I think it's only going to be a short-term opportunity because I just don't see one jobs print specifically changing much. The focus is going to be on inflation. The bank is very focused on inflation right now. And again, don't get me wrong, if we get a big deviation, yes, it could see the markets flip-flopping between whether they cut or whether they hold, but the main focus is going to be on the inflation data. So it's going to be a short-term trade for me out of this one. I just don't see much scope for anything else, after this week's BOC. Now, I do think that there is two-way possibilities, though. I think we could trade the CAD higher on a strong number and lower on a weak number, which isn't something we are normally open to do. Normally we have more of a set preference that we would like to trade, right? Normally we would only trade a beat or only trade a miss. But when it comes to today's NFP as well as the Canadian jobs data, I think there's two-way risks. We could definitely trade this both ways. However, NFP has the potential to create a ton of two-way volatility across major asset classes today. The reason for that is where we are right now when it comes to US data, looking at the NFP scenarios we looked at earlier. There is the potential for a wide range of outcomes here today, which could have vastly different implications for markets across the board. And that, for me, means it's going to be very tricky and arguably a little bit too risky to want to trade the Canadian dollar in the crosses. Right, I think the best case scenario that we can hope for today for the Canadian data is to see a clear differential between the Canadian data and the US data. Meaning if the US data comes in really, really bad, if we see that very, classic dovish reaction or dovish outcome, to potentially then trade dollar CAD short if Canadian jobs comes in very high, or if we see a decent upside surprise, and vice versa, if we see really strong US data today with that ideal hawkish outcome, then potentially looking for dollar CAD longs if the Canadian data surprises lower. I just don't see a lot of scope for trading the Canadian dollar in the crosses, just because there's so much two-way risk across the board today. This NFP today doesn't feel like a normal one because the markets are just overly sensitive right now when it comes to economic data coming out of the US, right? We've seen it happen quite a few times now, and that makes me a little bit reluctant. It makes me reluctant to want to trade the CAD versus something like the Kiwi or the Aussie. If it wasn't for the big two-way risk out of NFP today, then if we got a really, really weak print out of the Canadian data, then I would have probably wanted to look for something like, Kiwi CAD extensions to the upside. If we had a really strong print, I would have probably looked for something like Aussie CAD weakness, to trade that lower. But again, I think when it comes to the crosses, there's just too much risk right now. I think the only way that I would be interested to trade that Canadian data is versus the US dollar. And that means we want to see a very clear differential in play. Strong US data with weak Canadian data, weak US data with strong Canadian data. I just think that's going to be the simplest, the cleanest, the clearest way to trade in today's session. And if we don't get that type of outcome, I'm just going to ignore it, right? It's Friday. The last thing that you want to do is jump into a trade out of a super volatile event like this, and have it run you over going into the weekend, right? When it comes to these events, if you don't get that very clear, no-brainer, high probability, high conviction opportunity, why take the risk, right? Wait for the right opportunity to present itself, and then we jump for it, we execute on the trade, like we did with the dollar CAD earlier this week with the ISM services print that we had. But even that trade, it was a very quick, fast trade. We jumped in out of the event, we rode it for a couple of pips high, and we got out. I don't see scope for trading anything more than that in today's session. And again, I think dollar CAD is going to be the simplest way, but that means we'll need to see that clear differential, either strong data on the US side compared with weak data in Canada, or either weak data in the US compared with versus strong data in Canada. I just think that's the way that we need to play this. We need to have that differential. The crosses it feels a little bit too risky in a session like today, given the hype about NFP. Now, something to always keep in mind when you want to trade Canadian jobs data is what's great about the Canadian as well as the Australian jobs numbers that we get is they actually give us the breakdown in the data itself, the release itself, between full-time and part-time employment. Now, why that's important is because from a monetary policy point of view, full-time employment is always going to be the more important one, right? That's going to have the biggest impact in the economy, potentially biggest impact from a longevity point of view in the economy. The full-time jobs number is always important. That means that whatever we get on the headline, whether it's a strong miss or a strong beat, we ideally want to see the full-time number confirm what we get in the headline. What we don't want to see is a strong beat or a strong miss in the headline, but the full-time number showing the exact opposite. If it's all based on part-time jobs, the market tends to discount those types of prints very, very quickly, very easily as well. We don't want that type of outcome, right? So for us, the base outcome would be strong upside surprise in employment, which is followed or confirmed by full-time employment, or a very weak number, which again is confirmed by full-time employment. So whatever that number is on the headline, make sure that the bulk of it is coming from full-time employment. Otherwise, the market tends to just discount that fairly quickly. And we don't want to trade something like that. Now, let's quickly take a look at what we need to see for a possible trade here today. Let's start with, I actually want to start with the unemployment rate, because unemployment is expected to tick up from 6.1 to 6.2 with a minimum expectation of 6 and a maximum expectation of 6.3. Now, if we take a quick look at the chart here, any type of print above the prior, which already is the market's baseline expectation, right? We're already expecting that to go to 6.2. Any print above the prior is already going to be a new cycle high. And the CAD hasn't moved in anticipation of that, right? So I don't think a move up to 6.2 will really do the trick. I think for us to have the best opportunity as a miss here, we probably want to see the market's print or the unemployment rate print above the market's maximum expectation. Let's just keep it simple. A number like 6.4 or higher should get attention, right? That could get the market's attention for sure. What about to the downside? Again, anything below 6.1 will already be below the prior, but I think for the base bang for our buck for a trade here, going down to 6% alone probably isn't that sexy. The minimum expectation, by the way, is 6. We probably want to see a 5 handle on that. We want to see that going down to 5.9 or 5.8. Something with a 5 probably gets us a slightly more sexy trigger to trade with. If we don't get something that's that shocking, I just don't know whether it's going to be worth the market's worth the reaction or worth the trade to try and see whether that gets the market's attention. What about the jobs number? So just to clarify, what we are looking for a bad print, we're looking for a number like 6.4 or higher for the unemployment rate. For a very good trade, for a beat in the data, we're looking for a number with a 5 handle, something like 5.9 or lower. What about the jobs numbers itself? Last time around, we had that huge upside surprise, right? 90,000 jobs added. Only 40,000 of that was full-time, by the way. So what are we looking for here? Look at the forecast distribution. The minimum expectation is -5. The maximum is 65,000. That is an extremely awkward forecast distribution to work with. I think what that means, to give us the best bang for our buck, we either want to see a number that is high enough to give the markets conviction that this print we had back in April wasn't a flash in the pan move. That means that we probably want to see a print somewhere above or in the vicinity of the maximum expectation. We want to see something like 65. Why between 65 and 70? It's still the highest print going back all the way to January. You know, if we print above 64,000, it'll be apart from the one we had more recently, it'll be the highest still going back to Jan 2023. So the highest we can go, let's just say above the market's maximum, means that a lot of that jobs that we saw in April, it wasn't a flash in the pan move. We're not going to see a huge mean reversion. If jobs comes in strong again, it shows us there may be something more to it. That's what I think we need to see on a beat. We need to see something very close to or above the market's maximum expectation, ideally above that September 2023 number of 63,800. What about the miss? The minimum expectation is -5. It makes it tricky when you have that type of wide distribution. I think as a bare minimum, we probably want to see a number coming in. Sub 15, right? We want to see if we print somewhere close to 10, it'll firstly show the markets that what we got in April was just a flash in the pan move to the upside, right? If we get something like 10, it'll basically be a complete reversal of what we had last time, but it won't be a negative number. So at 10, it'll still be on average one of the lowest job prints apart from the negative ones that we've had going back to Jan 2023. So we are probably looking for a number as close as we can get to 10 for a miss, and a number as close to as we can get to 65, maybe 70 to the upside for a beat. Now, assuming for a second that we do get that beat and we do get that type of miss, again, I'm not going to trade this in the crosses. I'm only going to trade this versus the US dollar. So what I will be looking for here, going back to our trade plan from the NFP, if we see that ideal dovish outcome for the US with its data, and we see the Canadian jobs printing, 65,000, the unemployment breaking below that with a 5 handle, dollar CAD shorts looks like a very attractive opportunity. We've got some very key levels to aim for to the downside, 136.50. Below that, we've got the implied vol low coming in around that 136.20, and then we've got the 136 flat below that. What about a strong miss, a big miss in the data? What if we get that 10,000 print, and what if we get that 6.4 that we've been looking for? As long as we can see the US data then coming in very strong, then dollar CAD upside looks like the best case scenario, right? In that case, same levels that we were looking at earlier. Implied volatility, the implied volatility high comes in close to the 137, so that'll be a first, level of resistance just to watch. But the obvious magnet here would be this whole series of highs going back to the last couple of weeks, which comes in around that 137.30. That's probably going to be the best area that we can hope for as a potential magnet for profit taking on a strong US data point with a weak Canadian data point. So again, for the crosses, it's just, for me, it's a little bit too risky in a session like today. I want to keep it simple. Green here and red here, or red here and green here. Otherwise, I'm just going to let this one run.